Hello everyone and welcome back for another edition of the Money Pros. I'm Oliver Tutt, Certified Financial Planner Practitioner, and I'll be your host for the next half hour as we talk about all the issues related to your money, how to make it, how to keep it, and how to help it grow. I've got a lot in store for today's show, and because I didn't win $1.6 billion in last night's lottery, I am here to tape this show for you. So everybody should be grateful, I think, except for me, because I didn't win. But it's okay. So first up, we're going to be talking about, speaking of winning a giant lottery, the first thing you'd have to do is pay a bunch of taxes. So Kiplinger's is out with their list of the least tax-friendly states in the United States. And some of the names on the list may surprise you. Some of them may not. We're going to be talking about that. In our second segment, we're going to be talking to our mortgage pro, Steve Tetzner with Homestar Mortgage. Very timely conversation. We're going to be talking about interest rates as they start to creep up, and Steve's going to fill us in on that. And then finally, in the third segment, we're going to be talking about volatility that has returned to the stock market. With fall rolling in, the stock market has gotten a lot more rocky. We're going to talk about some of the reasons why, so lots to get to in today's show. But first up, let's talk about Kiplinger's list of most, that's actually a twofold list. We're going to talk about half of it today's show. They did a list of the most friendly tax states and least friendly tax states, and we're going to talk about the least friendly tax states first. So Kiplinger's does a really good job with this. They don't just look at income tax rates or sales tax. They go through every tax that a resident of the state might have to pay, whether it be state income taxes, local income taxes in some jurisdictions, property taxes, both state and local, estate taxes, sales taxes, gas taxes, all of the tax load that somebody could experience as a resident of the state. And it may not come as a surprise that many of the worst, in fact, of the top 10, I think 7 or 8 of them were in the Northeast. So, well, it couldn't have been 7 and 8, but several of them were in the Northeast. I don't have the full list in front of me. We're going to be talking about the top 5. But there are also a number of states that are outside of the Northeast. Some of them came as a bit of a surprise. So we're going to go down the list and look at the 5 worst states from a not tax-friendly standpoint and talk about some of the things that stand out. So let's throw up the slide and we'll talk about these one by one. So number 5 is Maine, of course, a state here in the Northeast. So the main thing Maine's got going against it is very high average state income tax. Their brackets are very narrow, and the potential rates can be higher than the average in the United States. It wasn't about property taxes or sales taxes or things like that. Maine has moved recently to get their state income taxes more in line with national averages, but they remain high historically. So number 5 is on the list, is Maine. Number 4 is Illinois. Now, Illinois is kind of an interesting one. They have the dubious distinction of having the largest state budget deficit in the United States. So this is a state seriously hurting for money. They have the second highest property taxes in the entire nation. They also have very high sales taxes, and in certain jurisdictions in Illinois, you can also be subject to local income taxes if you live in Chicago or certain other jurisdictions where you have local income taxes to pay. Number 3, I don't think there's any surprise here, New York. The highest state income tax in the country is in New York, plus local income taxes like we were talking about in Illinois. And their local income taxes, depending on where you live in New York, could be as high as 1.94%. So nearly another 2% potentially in local income taxes on top of an already high state income tax. They have the 10th highest sales taxes in the United States, and property taxes tied with, wait for it, Rhode Island at the 10th highest in the nation. So New York comes in at number 3 on the least tax-friendly list. Number 2, Maryland. Kind of interesting. Mid-Atlantic, never would have guessed Maryland. Not a lot of things going against Maryland. What it boils down to is they have very high state income tax rates, coupled with also potential local income taxes depending on what jurisdiction you live in. So a lot like Maine, it's mainly the income taxes that are driving it, because they don't have particularly high sales taxes, estate taxes, etc. And finally, number 1 on the list, this one really came as a surprise to me, is Minnesota. One of the highest income tax rates in the country and very high state and local sales taxes. So sales taxes and income taxes definitely going against Minnesota. Now, you might be wondering, how did Rhode Island do? They didn't rank all 50 states, but they did rank Rhode Island as a not tax-friendly state. It just didn't make the top 10, but they did indicate it was not a tax-friendly state. I don't think there's a lot of surprise there. And Massachusetts, interestingly enough, known as Taxachusetts, was ranked as moderate or in between, so not the best, not the worst. So some interesting information. We'll cover the most tax-friendly states in another episode of the Money Pros. All right, up next we're going to be talking to Steve Tetzner about interest rates. Stay with us, there's more to come. Hello everyone, welcome back to the Money Pros. I'm joined now by our mortgage money pro, Steve Tetzner from Homestar Mortgage. Steve, thanks for joining us. Great timing for this, right? We're going to be talking about interest rates, and there's a lot of activity on that front. So before we jump into the whole interest rate conversation, probably a good lead into it is always like to get your feedback on where you see the real estate market here in southern New England right now, how things are going, how the summer was, et cetera.
It's been a crazy year. It was a huge buyer's market right through mid-August. Mid-August, the brakes went on. It's like somebody threw a switch. Now, we normally have a lull for about 3 weeks, sometimes 4 weeks. You know, the last 2 weeks of August, a lot of people on vacation, kids going back to school, and then things pick back up again, you know, by mid-September. Didn't happen this year. We're back into the flow now, but the lull was probably 2.5 weeks longer than usual. Definitely not a seller's market anymore. We've definitely moved, the pendulum has moved now into the buyer's side.
Really?
Yeah, I think what we've seen is, you know, with a tick up in the interest rates, and also the prices were just going crazy. I mean, they were going up at exponential numbers, and I think the buyers finally stepped back and said, you know what, this is getting a little out of control. Sellers starting to get a little bit greedy with what they thought they could get for their houses, so we started to see those houses sit. What we're starting to see now is reduction in prices. The buyers are coming back into the market, more of a balanced market, but I would say swayed a little bit more towards the buyer's side right now. It's a good time in the fall.
Interesting. I haven't heard that in a long time. I mean, it's been a seller's market, it seems, pretty consistently, and even when it seems like we've had slowdowns, I feel like people have attributed that to lack of inventory and not lack of buying interest. But you're saying that the pendulum might be swinging a little bit toward the buyer's side.
Oh, it definitely has. It's in the buyer's camp for sure.
So there are probably a lot of reasons for that, and we want to focus in on interest rates as a particular topic, recognizing we always point this out when we start to talk about rates. This is taped about 3 weeks in advance of this particular show, so viewers should keep that in mind. What's been going on with interest rates this year, and in particular recently?
Well, interest rates this year are up about 0.5 to 0.6%. In the last Fed increase, we did see the rates, you know, the Fed raised a quarter last month, we went up 1/8. So we're seeing the rates gradually moving up close to 5%. They're still just under 5% on 30-year money with good credit and, you know, 20% down. But I think that the rates are really affecting the moderate to lower end market a lot more than the standard buy-up, you know, move-up buyer or the high-end buyer. Rates have less of an effect on them. If the interest rates are okay, even if they're a little high, they feel confident in, you know, in their position, their job, and they can afford the payment, they'll still buy.
Okay.
But in the lower end market, when rates move up a point or 3/4 of a point, it's starting to price people out. So you've got house values going up, interest rates going up. So that person 2.5 years ago that could afford a $150,000 house, now $150,000 houses aren't there anymore. Those houses are now 180, and now the interest rates that were a point lower are a point higher. So now they can't afford those 180 houses. So it's starting to push some of the people in the lower end market out of buying a home.
So you're definitely seeing it, even though it's a slight increase, you're definitely seeing it play out in terms of buyers' decisions, but more so on the lower end of the market.
Not just decisions, but ability to buy. They're priced out to the point where, you know, they can't qualify for the mortgage because now the payment with the combination of the increased rate and the increased home value is beyond their reach.
So they're either going to have to save up a larger down payment and continue to rent or do whatever they're doing until the situation changes, essentially.
Correct.
we talk about this a lot. I think it's important to revisit it, and you referenced the Fed hiking rates. So the Fed has hiked rates 3 times this year.
Correct.
And we know that that has an impact on the overall interest rate environment. But the Fed really impacts short-term rates, and of course mortgages and long-term debt. What's really driving the mortgage marketplace, and how does that how does that dynamic affect where mortgage rates are? Because it's not directly the Fed, and I think a lot of people think it's the government, saying, all right, it's going to be 4.25 this month.
You're exactly correct. Well, it's the same factors that are affecting the Fed's decision to raise the rates. We're seeing inflation. You're seeing growth in the economy, where we've seen 3-4% growth projections in different quarters. So when you have growth, interest rates go up. When you have a stronger economy, interest rates go up, short-term and long-term. But the Fed does not directly control mortgage rates. But the decisions that, the factors that are making them raise rates are the same thing that are affecting the mortgage rates. The employment, unemployment, I should say, is very, very low right now. Wages are going up. Everything is positive in the economy, so that's driving mortgage rates up. It's driving home values up. And as I said, in the medium and high-end market, and even in the low-end market to a certain degree, the rates don't have as big of a bearing as people think. But in that lower-end market, where it's the difference between being able to afford and not afford, those are the people that are really being hurt by the increase in rates.
You can almost think about it in terms of what is the difference of $100 a month mortgage payment mean for somebody that's staring down a $3,000 a month mortgage payment. That's that's noise right around the edges. But when
Correct.
you're talking about a $1,200 mortgage payment, it can become a big deal when you factor in taxes and insurance and everything else that they're probably worrying about. And we also talk about, with respect, interest rates. Do you, I look at the 10-year Treasury a lot. That's what I use as sort of my indicator for where interest rates are. And we see the yields on that going up in conjunction with mortgage rates. Do you think that's a good indicator for where mortgage rates are going?
The 10-year is probably the best benchmark for a consumer to look at as the trend of what's happening with rates. When the yield on the 10-year is going up, then you're going to see mortgage rates correlate to that. It's not on a daily basis an exact dollar for dollar, but in a general trend, absolutely, that's probably your best indicator.
So we recognize rates are going up. We've talked about how it's impacting the lower end of the market more so than the higher end of the market. But you've got to have people coming to you all the time that are aware of what's going on with interest rates, at least to some extent. Maybe their information's accurate, maybe it's not.
Yeah.
What advice are you giving people that are in the market, shopping, maybe haven't found the house yet or just about to find the house? They're in that sort of stage and they see this activity with interest rates. And are they changing their borrowing decisions? Are there different products or opportunities or strategies they can use to mitigate the rising rates? What's your advice to these folks?
Buy sooner rather than later, because I think the rates are going to continue to go up. Rising rates also help people make that decision because they want to buy now and lock in the rate before the rates go up. The fall market is probably one of the best markets for the buyers. There's a lot less competition with people out there trying to buy. Somebody who has their house on the market right now is serious about selling it. A lot of people like to wait till spring to buy and sell. There's a lot more competition there. You're going to be going into an open house with 20 other couples again, potentially in the spring. Right now, you can do it. And we're seeing the contingency offers back, where somebody's able to make an offer where it's subject to them having to sell.
That's interesting.
That's a great opportunity for buyers. If you're going in and that buyer has what we call a Hubbard clause to purchase another home, where they've entered a contract to purchase somebody else's home, but it's subject to them selling, they're a very motivated seller because they don't want to lose that other house. So we're seeing those people starting to negotiate and come to the table with some very reasonable negotiations and prices on their house.
That's an interesting point because it seems like over the past year or two, contingency offers was just like, don't even bother. I've had real estate agents say, it's just not going to happen, right? Because they're going to get several offers that are going to be cash or people ready to go or things like that. Big decision that borrowers have to make is a question about a rate lock. I'm presuming that in this atmosphere with interest rates going up, rate locks people aren't letting their rates float. Is that right?
Right, but you cannot lock a rate until you have a contract to buy a home. Because when you lock a rate, you're locking that rate to close within a finite period of time, either 45 days or usually 60 days. So if you have not identified a property, it's unlikely that you're going to identify a property and close on that property within that time frame.
So if you're the buyer that's actively hunting, but you haven't identified the property and signed a purchase and sale, it's a moot point for you. But once you've signed the purchase and sale, then you have an opportunity to lock in the rate. And can you just repeat for me, I think what you just said, which is, what are your opportunities for how long you can lock the rate for?
You can lock a rate for 360 days, but the rate that you'd lock in, let's use a 90-day or 180-day rate lock. If you lock an interest rate in, the typical rates that you see marketed are 30 or 45-day rate locks. That means that from the day that you lock, you have to close on the transaction within that time frame. If you're buying money projected into the future and you're not going to close for 90 days or 180 days, you can lock that rate, but not at the same rate as a 30 or 45 day.
Presumably it's going to be a higher rate.
Much higher.
So you're, as a borrower, you're facing a little bit of a challenging decision, because you may have a situation where you can't close quickly, or you don't want to close quickly, and you have to balance that out against the decision of what it's going to cost you to lock a rate for that period of time. How are you coaching people with that?
For people that are going to close within 90 days or less, I'm recommending that they lock the rate, because I think in the short term we could see rates going up, where they could get hurt.
But outside of that, you don't think it's worth it based on the premium?
Based on the premium, I think you wait.
It's a challenge, but it's interesting to hear that you feel like the market may have turned a little bit in favor of buyers, at least in the short term. We'll see how long that holds out. So fall is a great opportunity, sounds like.
Absolutely.
Steve, thanks as always. Appreciate it.
Great to be here. Thanks.
All right, when we come back, we're going to be talking about increased stock market volatility and what's going on. Stay with us. There's more to come. Welcome back to the Money Pros. I want to talk a little bit about stock market volatility. As this show is being taped here toward the end of October, definitely seeing a lot of volatility return to the stock market. Now, what is volatility? It's action from day to day, highs and lows. So it's not all bad. Some days can be big days to the upside. Then we have a lot of big days to the downside. If you think about it like a roller coaster, it's a pretty rocky roller coaster. And that is volatility. We can actually look at volatility based on a lot of different metrics. And the most common metric is called the VIX, the VIX. And the VIX is an index created by the Chicago Board Options Exchange, and it illustrates the expectation for volatility in the S&P 500 over the coming 30 days. So when the VIX goes high, investors are expecting more volatility, and when it goes low, they're expecting less volatility. So I thought it would be interesting to put up a graph of the VIX so far for 2018. So if we can hit that, what you're going to see here is that so far 2018 is kind of bookends. First off, in January, you see some significant peaks, January into February here, where we had significant volatility in the stock market. In fact, the Dow experienced its first ever 1,000-point drops. It did that twice in February. And then volatility continued through the first quarter and into the second quarter of 2018. But the summer, you can see as that line decreases and gets somewhat flat, the summer was a relatively low volatility period for the stock market. In fact, it was kind of nice to be on vacation and not have to worry about what was going on in the markets, because there weren't very big day-to-day moves. And that's actually counter to what usually happens. Oftentimes it's more volatile. But now you can see in October, you see a significant spike in volatility. In fact, so far in October, we've seen a lot of action in the stock market, and volatility has increased significantly, and that's got some people worried. It's understandable. So let's talk about some of the reasons. So the first one I want to talk about is exactly what we were talking about with Steve Tetzner in our last segment, and that is interest rates. Interest rates impact every facet of our economy, and none more so than the stock market. So most people don't realize that when interest rates go up, that is generally bad for stocks. And it's bad for stocks in two reasons. One is a somewhat obvious reason, and that is when interest rates are higher, that means investors have another alternative place to put their money. And of course, when you buy bonds that pay a fixed interest, that risk is a lot lower than being in the stock market. So people are enticed to take their money out of stocks and put it into fixed interest rate investments. And that enticement becomes even more attractive when interest rates are higher. So that's a challenge for the stock market. The other challenge is less intuitive, and that is that when interest rates increase, that lowers the present value of the cash flows from dividend-paying stocks. You take a dividend-paying stock and a stream of payments going out into infinity, you discount it at a higher interest rate, the present value of that stock goes lower. So there's an automatic economic relationship that drives the value of stocks lower. So interest rates definitely playing a role. Second thing we got to consider is corporate earnings. We're right now, here at the end of October, we're in the middle of corporate earnings season. Companies are announcing their results for the third quarter, and there's some indication that growth is slowing down. In fact, right before this taping, two big bellwether companies, 3M and Caterpillar, announced what many consider disappointing earnings for the third quarter. And I think it's important to point out as a side note here, Caterpillar mentioned that one of the reasons their earnings were down was because of higher material costs related to tariffs. So there's a question mark about to what degree the tariffs instituted by the current administration are impacting the economy. And the final thing I think it's important to point out is a looming midterm elections. The stock market hates uncertainty, and there's a lot of uncertainty about how the midterm elections are going to go. The Democrats, are they going to take over the House? Are they going to take over the Senate? Are they going to take over neither one? What's going to happen? A lot of uncertainty generates volatility. So those are some of the things behind the volatility. The more you understand about it, hopefully the more comfortable you are with it. This is just part of the price of admission, so you got to roll with it if you're an investor. All right, up next, we'll tell you how you can ask us a question if you've got one for the Money Pros. Stay tuned. Welcome back to the Money Pros. We want to give you an opportunity to ask us questions. My favorite thing about doing the show is when I get questions from viewers. It's interesting. I like to know what you want to hear about, and so that's exactly what we want to talk about. And a lot of the questions I answer right here on the air, but I answer all the questions, whether it be through email, Facebook, or whatever. So if you have a question for the Money Pros, any of us, including me or any of the people you see on this show, you got a few ways you can ask. First off, track us down on Facebook, look for the Money Pros, post a question. You can even private message me a question if you're shy. Second off, you can go to foxprovidence.com, click on the Money Pros, and click on Ask the Pros, and you can message us a question that way. And finally, you can send me an email, moneypros@foxprovidence.com. Shoot me an email. I respond to all of our messages. I make sure we get the best information we can for you, and hopefully it's a question we can use on the air, and there's nothing better than doing that. All right, that's it for today's show, folks. Have a great day. We'll see you again next weekend. Take care.